think we'll have 10 pretty good years in the silver business. That will be marked by cyclicality. Remember, a 50% decline. I bought a lot of silver when silver was hated. It became clear to me that the silver stocks offered more upside than silver. I likely would lose less money in the silver stocks than I would in silver. You know, these guys get silver as a byproduct. Their cost to produce silver is really a function of their ability to recover it from the product stream that's paid for by copper mining. In the gold business, at this price, the gold producers are coining money. They're making a lot of money. I don't believe that $5,000 is an incentive price for gold. I save in gold personally because I believe that the US dollar will lose 75% of its purchasing power. Silver for me is a speculative element. When it was hated, I speculated. When that speculation came good, I sold 80% of my physical silver. I maintain my physical platinum holdings despite the increase in the platinum price. I'm speculating there on the fact that platinum is produced principally in South Africa, Zimbabwe, and Russia, that social and political threats to production.
You sort of warned us that silver was over leveraged and volatility was coming. And then we saw what we saw in January 2026. We went through that, experience that massive price drop. But how closely did what we saw back in January match what you were seeing back then? And does that flush change your medium term outlook on precious metals?
I think it's important to note that I wasn't expressing anti-silver sentiment. What I did, I bought a lot of silver when silver was hated because I love to buy hate. Markets that are hated are markets where we don't have much competition on the buy side. Silver below $20, particularly where all the social media comment around silver was hated, suggested that all the sellers in the silver market were gone, those expressing their opinions had already acted. And if the asks go away, prices respond. And so I figured that all silver had to do was become less hated for the price to go up. So I bought a bunch of silver. Then silver became less hated and the price went up. As a speculator, when the circumstance that you're speculating on occurs, you either have to sell or you have to revisit your thesis. And so I revisited my speculative thesis. Silver wasn't hated anymore. And so there was no more hate rebound in silver. It was all a momentum trade. And looking at the momentum trade, looking for where the best bang for my buck was in my speculative portfolio, it became clear to me that the silver stocks offered more upside than silver.
A violent reset in silver sentiment often signals positioning failure, not just price correction. Silver's drop below prior support levels revealed how quickly momentum trades unwind when narrative support disappears. As Rick Rule points out here, the shift from hate-driven buying to momentum chasing removes the structural edge that originally powered upside. That transition exposes fragile positioning across both physical and equity exposure. For investors, it signals a regime where corrections reset leverage faster than fundamentals adjust. Next, Rick Rule reveals how equities quietly outperform even when metals stagnate.
If silver traded sideways, as an example, it was about $75 at that time. If it traded sideways for a year, by definition, I wouldn't make any silver. But the silver stocks were priced in the market as though silver was trading at $45. Which meant if the price of silver went sideways, the silver stocks could go up anyway. If the price of silver went up, the silver stocks would benefit. And paradoxically, if the price of silver went down because of the implicit discount in equities valuation, I likely would lose less money in the silver stocks than I would in silver. So when I sold my silver, approximately 50% of the proceeds went to high-quality silver stocks, which I felt to be a better speculative use of money. 25% of the money went to oil and gas companies, which were still hated. By the way, I had no idea that we were going to have a Persian Gulf conflict, so don't give me any credit for prescience. That had nothing to do with it. It's just that it was hated. And 25% went into savings, mostly physical gold. And I'm not unhappy with that, despite the fact that the gold price has fallen. I'm saving with 10 or 20-year horizons, and I feel quite good about the gold. I did not express anything with regards to the silver price. I just suggested that a more economic expression of the silver market was the silver stocks rather than silver itself.
Markets can appear stable while underlying pricing assumptions quietly diverge. Silver equities were effectively discounting a much lower implied silver price, creating asymmetric upside even in sideways conditions. As Rick Rule points out here, this mispricing allows equities to outperform in multiple scenarios while physical metal remains linear in exposure. The gap reflects how sentiment, not spot price, drives equity valuation during transition phases. For investors, it means capital can rotate into structures that outperform even without directional moves in the metal. Next, Rick Rule reveals why hated sectors often lead the next cycle.
My experience has been that, well, my experience suggests that precious metals are in for 10 pretty good years. And my experience has been when the generalist investor comes into the precious metals market, that silver outperforms gold. For me, this has become an investment thesis represented in silver stocks rather than in physical silver. People who like to speculate or invest differently, I think will have 10 pretty good years in the silver business. That will be marked by cyclicality. Remember, a 50% decline in 1975. And it will also be represented by volatility. And I would suggest that what we've seen in the period January through April in the silver price has everything to do with volatility and little to do with anything else. If you can't stomach volatility, you have absolutely no business owning physical precious metals.
Agree with that one. But with the metals right now, I guess in particular gold, silver, and platinum, do you see them as fairly valued right now, undervalued, or overvalued?
I think it's arguable that given the economic circumstance that faces us today, that they're reasonably valued. It's difficult to value silver in a conventional sense because only about 18% of primary silver supply comes from silver mines. The rest comes from recycling and base metals mines. So on the supply side, the price of copper and the access to capital by copper producers is more important than the silver price.
Volatility is not noise in metal cycles. It is the mechanism through which weak positioning is cleared. A historical 50% drawdown in silver cycles shows how quickly sentiment resets even within long bullish structures. As Rick Rule points out here, silver's outperformance depends entirely on cyclical investor inflows rather than stability or predictability. That means drawdowns are structural, not accidental. For long-term holders, ignoring volatility risk leads to misaligned exposure that can underperform even in bullish decades over time severely. Next, Rick Rule reveals why most investors misread cycle intensity.
You know, these guys get silver as a byproduct. Their cost to produce silver is really a function of their ability to recover it from the product stream that's paid for by copper mining. In the gold business, at this price, the gold producers are coining money. They're making a lot of money. In the platinum business, I think it's politically constrained. The utility of platinum appeals to me, which is to say that platinum as an essential component in things like catalytic converters means that if the price were to double, demand wouldn't fall, at least in the near term. So each have their own attributes. I save in gold, not because I don't believe that $5,000 is an incentive price for gold. I save in gold personally because I believe that the US dollar will lose 75% of its purchasing power in 10 years. And I believe that gold will roughly maintain its nominal purchasing power. So on a standalone basis today, I don't think that gold is unattractively priced, but I think it's an attractive asset because I think that there's a probability, not a possibility, but a probability that fiat-denominated savings products, which I would otherwise be a consumer of, will lose 75% of their purchasing power over 10 years, mirroring. Many people don't realize this, but the U.S. dollar lost 75% of its purchasing power in the decade of the 70s. I don't think that there's anything that is a more important determinant.
Currency strength narratives break down when long-term purchasing power erosion is ignored. The US dollar's 75% decline in the 1970s shows how inflation cycles can silently restructure wealth distribution. As Rick Rule points out here, gold's role is not speculative upside, but preservation against fiat erosion over time. That reframes pricing debates entirely around monetary stability rather than short-term valuation. For investors, gold functions less as a trade and more as systemic insurance against currency debasement accelerating beyond official expectations. Next, Rick Rule reveals why fiat trust erosion drives capital rotation into metals.
Of the increase in the gold price that occurred in that decade, than the unprecedented deterioration in the purchasing power of the U.S. dollar.
Rick, a lot of the precious metals investors that I see, they buy a metal and that's it. They stick with it. If it's correct for me to say you're a fundamentals and value investor, do you see merit in systemic, at times rebalancing, meaning perhaps repositioning some of your gold into silver or repositioning it to platinum, especially with what we just saw last year with the gains of silver and platinum over gold?
I think that depends on the individual investor. I don't think that there's a one-size-fits-all stratagem. I save in gold, and I save consistently. So I buy gold relative to the price of other instruments, but in a consistent basis, I save in gold. And I'm sort of price agnostic. I mean, yes, I probably save less during periods of high prices. I didn't make allocations to gold in December and January, except in January when I sold my silver, because gold was on a tear, and I don't like hyperbolic charts. Hyperbolic charts almost always resolve themselves. Silver for me is a speculative element, and when it was hated, I speculated. When that speculation came good, I sold 80% of my physical silver.
A silent shift in allocation discipline, though, often matters more than headline price action during macro cycles. Gold's steady bid contrasts sharply with speculative rotation timing across metals markets. As Rick Rule points out here, consistent accumulation beats reactive repositioning because extremes in sentiment tend to unwind violently. The key question is not returns, but capital survival through cycles of overextension. For investors, this highlights how disciplined accumulation can outperform tactical switching during volatility regimes that repeatedly reset leverage structures. Next, Rick Rule reveals why he avoids chasing hyperbolic price behavior.
I maintain my physical platinum holdings, despite the increase in the platinum price, as a speculation. I'm speculating there on the fact that platinum is produced principally in South Africa, Zimbabwe, and Russia, and that there are, as a consequences of that, social and political threats to production. Those are fairly unstable jurisdictions. And to the extent that those jurisdictions became more unstable, you could see dramatic declines in the production of platinum. I think anecdotally that the last period of rapid decline in the platinum price happened 89, 90, 91, which coincided with a period when Russia needed money. And I think Russian dishoarding of their platinum stocks is what depressed the price in 89, 90. I think Russia began needing money too in the onset of the Ukraine conflict. I note that by 1992, the Russians had run out of platinum to sell, and the platinum price rebounded. And I wouldn't be surprised if 2025 was the year that the Russians ran out of platinum to sell. And so the price controls that were affected by Russian inventories are gone in the platinum business. But I don't consider for myself platinum to be an investment. I consider it to be a speculation, and I maintain my holdings because I think there's a probability, a possibility, not a probability. In other words, a less than 50% chance that sometime in the next 5 to 10 years, you will see extreme political turmoil.
Commodity supply risk often hides inside geopolitical stability assumptions that markets quietly price as permanent. Platinum output concentration in politically fragile regions creates asymmetric shock exposure. As Rick Rule points out here, past price suppression cycles align directly with state-driven supply liquidation events. The unresolved variable is whether current inventory buffers mask structural fragility. For investors, this means platinum behaves less like a commodity and more like a geopolitical option with binary repricing potential under disruption scenarios. Next, Rick Rule exposes how scarcity cycles re-emerge when supply buffers collapse.
Social turmoil in particularly either South Africa or Russia. Note that I say less than 50% chance. But if that occurred, it wouldn't take very much to see a doubling or tripling in the platinum price. I think that that's a contingency worth speculating on, not a certainty worth investing in.
We touched on the strength of the dollar, but on the flip side, there's also de-dollarization going on, especially still from the BRICS. So I just wanted to get your opinion on should this the way things are going right now with the conflicts. Do you think this whole de-dollarization thesis, let's call it, could actually be speeding up?
Yeah, speeding up, but the U.S. dollar global hegemony is not over. Being nibbled at around the edges. My friend Doug Casey, who you should interview sometime, famously says that the U.S. dollar is the worst currency in the world, with the sole exception of all of the others. He also describes the U.S. dollar as the prettiest mare at the slaughterhouse, which is to suggest that the purchasing power of the U.S. dollar over the next 10 years will fall. Other currencies will likely fall a bit more. Think about what might replace the U.S. dollar. Currencies that do not have as liquid or as transparent a treasury market. Currencies that aren't convertible.
Currency dominance erodes not through replacement, but through incremental loss of trust in alternatives. De-dollarization narratives often ignore comparative weakness across competing systems. As Rick Rule points out here, even declining USD strength remains structurally superior to fragmented alternatives lacking liquidity and convertibility. The contradiction is that global participants still default to the dollar despite criticizing it. For investors, this means capital flight risk is asymmetric. Alternatives must prove stability, while the dollar only needs relative persistence. Next, Rick Rule reveals why structural weakness still reinforces dollar dominance.
Currencies where the fundamentals are even less robust than the U.S. dollar. Doug Casey again described the U.S. dollar as an IOU nothing. He compared that with the euro, 16 backers, as a who owes you nothing. Compared with the BRICS, Brazilian reals? Really? That becomes a who owes you anything. A BRICS currency would be a construct of illiquid, unconvertible securities in opaque markets. That isn't a very difficult circumstance for the U.S. dollar to prevail in. In circumstances now where transactions occur between buyers and sellers in BRICS currencies, the currencies that are received are almost immediately converted into dollars for use in the real world. Now, I think the U.S. dollar hegemony will decline, not as a consequence, by the way, of economic reform in other countries, but rather because of the U.S. government's idiotic policy of weaponizing our currency. Whatever you think about the Russian escapade in the Ukraine, nobody in the world lost sight of the fact that the U.S. dollar stole $300 billion worth of Russian assets denominated in U.S. treasuries. Nobody can deny that the U.S. government has weaponized their the U.S. dollar to promote the extraterritorial expansion of U.S. law in countries that have their own laws. This can only reduce over time demand for U.S. dollars. The question is what benefits? And the particular beneficiary over the last 4 years has been gold.
Financial systems don't lose dominance when alternatives rise. They weaken when trust in enforcement systems fractures. Cross-border asset seizures introduce long-term confidence erosion in reserve neutrality assumptions. As Rick Rule points out here, the real risk isn't immediate replacement, but gradual preference shift away from politically exposed reserves. The contradiction is that enforcement power strengthens short-term control while undermining long-term demand. For investors, this creates a structural tailwind for neutral assets that sit outside sovereign liability chains.